Hello everyone, this is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms like you see here since 2003 for individual traders and professional institutions. By the way, guys, our systems have absolutely nailed it this year because of this market volatility. We've had about 110 trades that have been generated by our 22 subsystems that we run on both SPY and ES that we send out to subscribers. So if you're not a subscriber to Breakpoint Trades, you should sign up to start receiving those signals. I'm not going to be discussing those tonight. I haven't done a general market newsletter in a while. What you see here is our back-end recording for our standard web page newsletter. So let's go ahead and get started. Hello everyone, this is Matthew Frailey with BreakpointTrades.com. This is the comprehensive weekend newsletter for Sunday, November 6th, 2022. First off, I hope everyone's had a nice weekend. It's Sunday evening here, about 6:20 Eastern Standard Time. Again, this is the comprehensive weekend newsletter. If you happen to be new to these newsletters for the weekend are very comprehensive. We cover a little more charts, a little more comprehensive than our intra-week newsletters. You can see via the table of contents divided into 8 major sections. Again, I'm not going to discuss the systems tonight. We got enough charts here to discuss. Anyway, we first start off with the general market. We do a top-down approach from big picture charts all the way down to small time frames. S&P 500 and the Qs are our proxy. We'll then look at a few market sectors. I'm not reviewing all of them, just some of the major ones. We're also looking at EEM, that's emerging markets. We're also going to look at various important indicators like the VIX, breadth indicators, and other various comparisons. Look for divergences. We'll review bonds, TLT, high yield corporate, 10-year treasury yield, and the yield curve, of course. We'll look at currencies, US dollar, euro, Japanese yen, crypto. We'll do an extensive review on commodities, which have been in a bull market, as you know. We're also going to look at precious metals and precious metal stocks. GDX, GDXJ, SILJ, those are the ETF and a few individual names. We saw a strong reversal there on Friday, but we'll see if they can follow through or if Lucy grabs the football again, which has happened a lot this year. And trade ideas, I'm just going to go over some previous ideas. Remember, guys, midterm elections on Tuesday this week and CPI on Thursday. Okay, let's get started here. So first item below is the index sector table, what transpired last week on Friday, and of course for the week. You can see sorry about that, guys. I had a distraction. So anyway, you can see on Friday, major indexes had a pretty good rally. So did almost all the sectors except for retail. But for the week, everything closed down with, the S&P closing down 3.3%, Nasdaq and Index down 6.5 to almost 6%. Russell small caps down. Zoom in here a minute. Down 2.5%. Obviously, what's held up best this year is, anything with earnings, value plays. That's why the Dow this year has held up the best. As far as the major market sectors, like I said, pretty broad-based rally on Friday. For the week, mostly to the downside, though there were some sectors that closed up. Energy's been on fire, as you know. Currency-wise, US dollar had a big reversal on Friday, down almost 2%. That's a big move for the dollar. That, of course, helped the market, and it helped the precious metals and commodities area. Especially for the precious metals, we'll see if that area can continue or, if it reverses. It's had a lot of false starts this year. And cryptocurrencies were up nicely on Friday. We're up for the week. Commodities, big move on Friday, as you can see. Again, that big sell-off in the dollar helped. And for the week, nice gains here for the dollar, or for commodities. Natural gas up 12.6%, crude oil up 5.3%, general index up 5%. This is not what the Fed wants to see, guys. This doesn't help their inflation case. If commodities just go roaring back here. And precious metals here, gold up 3% on Friday, up 2.2% for the week. Silver, big reversal, up 8.6% for the week. GDX, the miners, now for the week, they are still lagging here, guys. All right, the stocks lead, but on Friday they did lead. GDX was up 10%. So we'll see what happens, what transpires this week. And as far as bonds, high yield corporate down for the week with the market, TLT down, which means 10-year treasury yields were up. Again, I'm not going to discuss the Fed, what they did last week. You all know about that. So, they raised rates by another 3/4 of a point. Next, item number 3 shows the economic news calendar. Again, we got a lot of stuff this week, guys. We have midterm elections. We still have earnings season. We have CPI on Thursday. A lot of things here. All right, let's go and jump to the charts. First image here, this was sent to me. I'm not sure who the author of this was. Looks like ElliotWave.com. But, so many market participants keep waiting for the Fed to pivot, as you know. That is why we've seen such gyrations. The market looks for any little hint that the Fed could stop or slow down their rate hikes. It's just so obsessed with it. But as this chart shows here, typically after a Fed pivot is not when the market bottoms. Look at these past examples. Fed pivoted here in the 90s, a 50% decline. Here in 2000, that was the 2000 highs, and then in 2008 you had a 58%. You had a Fed pivot, and then you had a decline here in the 2020 time frame. You can see the other time frames. So just because when the Fed does pivot eventually in the future, don't think that's necessarily the bottom of the market, guys. Yes, you may get a couple good monster rallies, but history shows longer term that the bear market is far from over when you do get a Fed pivot. Next, moving on to a few individual stocks, widely held stocks, Metaverse, Facebook, and this chart cracks me up, but anyway, this has been one heck of a casualty, down something like 75% for the year. This topped out at 384 back in 2021. We identified that as a fifth wave high, and we had no idea it was going to come down this high, this far. But anyway, as my little image says here, Zuckerberg, he may run out of tears before this thing bottoms. Better hope it bottoms soon, but there is a major support down here around this low 70s area. Resistance in 2014 became support in 2015. You also have your price by volume bars here. You can see they're the largest as you get down to these areas. If it gets down into here, perhaps it's worth a shot at least some sort of scale in, but boy, oh boy. Next. Chart number 6, here's Apple, Crapple. Now, this evening there was some news that came out about supply chain issues for iPhone 14, so it is likely to hit this stock negatively on Monday morning. Okay, this stock is not acting well. It's sold off Friday. It's obvious came off the lows. It bounced off this support area. You can see there's a support trend line here. There's the demand zone. So it did bounce off of here, but that news, we'll see if that negatively impacts this on Monday. But Apple is trading more like a penny stock lately, and that tells you the problems in the system, guys. Apple's down something like 15% here in short order. That is one heck of a decline in a short term. By the way, back here in August, when we marked this as a wave B high, we said it would form a lower high. A lot of people scoffed at that because we were so close back to the highs from March. People were like, no way we're going to top out there. We're so close, we're going to make a new high. But that ended up being the pattern, and we've been working on this wave C ever since. Okay, let's go ahead and get to the general market indexes. So first chart below, item number 7 here is a annual chart of the major indexes. So each candlestick represents 1 year. So this is as of Friday's close. So again, the Dow stocks have done the best. They represent value. So a lot of money hiding out in there. And I expect that to continue to outperform because, more of those stocks earn money, their value plays, and that's what's focused. That's what's been the focus of what the market has been focused on. S&P down about 21% for the year. Nasdaq down 33%. So techs have been taking it more. We saw that with Facebook, and recently Google's been selling off. Apple, IWM small caps, they've held up a little better than the S&P. Well, they're roughly the same, 18.9%. Commodities still continue to outperform, up nearly 30% for the year, and those are off the highs. TLT 20-year bonds, which a lot of brokers use, bonds have gotten absolutely hammered, down over 35% for the year. So that's what the yearly gains, losses look like for the indexes and bonds and commodities. Next, chart number 8, here's a weekly chart of the 5 key major indexes. All have these same type of expanding patterns here. You can see the Dow here. It's done the best this year, but it's still formed all these have formed lower highs, lower lows. The downtrend line here, that's your main resistance. The S&P, nowhere close to that. Same obviously for the Nasdaq. It's almost back to its recent lows. Here's the NDX, and here's IWM small caps, which have held up a little better. Next, chart number 9, here's a daily view of the major indexes. Again, the Dow has held up the best. That's your downtrend line for the year, connecting the January highs. Not too far away, honestly, from it. The S&P is right in the middle Bollinger Band area. The Nasdaq is basically back to its October lows, essentially. And small caps have held up a little better here. Let's move on now to our proxy, which is the S&P 500. Chart number 10, here's a monthly view of the S&P. Again, this is our bigger picture chart. This is the chart we were discussing last year, November, December, January, where we called the end of that bull market, which began in 2009, and the start of a bear market. That was before most people, most analysts, and that has been correct. So far this has played out. We've worked down into the lower portion of the channel. We haven't made it to the lower trend line of the channel. I'd love to see that. I think the market would then be due for a good maybe 4 to 6 month rally, maybe even longer. It will not end the bear market, but I'm not going to go into that tonight. But overall, we bear market this year so far, and we did a good job at identifying that fifth wave blow off high that ended that previous bull market. Remember, guys, bull markets many times end in blow offs, and that's essentially what that move was in the 2020 lows to the late 2021 highs. You had a typical slope here, uptrend of the bull market, and then that slope accelerated here. So that's typical bull market, end of bull market activity. Some other things I identify this. You could try this, guys, on a monthly S&P chart. Put a 14 link stochastic. In bear markets, it typically falls below 50%, like it did early this year. You could see it occurred in 2008 and also occurred in 2000. And in bull markets, your strong corrections typically stays above the 50% area. Next, chart 11. Here's a weekly view of the S&P. Again, so far, when price came down to that 200-week moving average a month ago, price did indeed find support there and to cut a little bit. A lot of people follow that 200-week moving average. It's very important. And we did come off of that. Okay. Moving average ribbon here got very extended. Whenever the moving average ribbons get too wide, like you see here, you do for reversion to mean rallies. And that's what has happened over the last several weeks. All right. Now the big question here, can we work our way higher up to this point, or have we started another decline in the bear market and are going to come down again here, especially after midterms, maybe to the lower 3,000s, which has been one of our longer term targets. All right. So we'll see. Next. Moving down to the daily charts, chart number 12, daily view. So a couple weeks back, I identified this diamond pattern. bullish diamond, and we did break out of that diamond. We also had a clear 5 waves to the downside with MACD and RSI divergence. So everything was set up here in early October for some sort of trade low, and we got that. So let me see. Anyway, price broke out of the diamond, broke this downtrend line, rallied up to that 3,900 area, which I said was major important. That's where it stalled. That was a good area to take a short, and then it sold off. Now, so far, we're still holding above this broken downtrend line. I think that's key. We need to hold above that. And if we start taking out last week's lows, that would be an issue, especially if you break this broken downtrend line. Okay. Next. Chart number 13, here's another daily chart I've been showing. Again, you can see the same 5-wave completion here in early October. So you expected some kind of rally after that. Anytime you get 5 waves to the downside, guys, expect a rally. Anytime you get 5 waves to the upside, expect a pullback. Okay, pretty simple. But another option here, which I talked about a couple weeks ago, would be the first rally up is a wave A. You get a higher low, wave B pullback, which we're working on. And you could get yet another move higher in wave C, which could take us up to that 61.8 fib retracement 4,000 area. Again, this is one option. The other option is this completed, and we're going to go down to new lows now. And I'll show you that on the intraday time frames below when we get to those. But the key now is, can we form a higher low here or not, wave B, or is it a more bearish pattern with this already completed? Next. Chart number 14, here's a 2-hour view with the fibs. Again, we got out of this channel. We had a little wedge-like pattern. We broke down last week. We bounced off the 50% fib. And the area, if we do get a little bounce earlier this week, this 3,800 area also is going to be an area to watch for resistance or supply. Okay. Notice how the 61.8 fib comes in pretty close to the broken downtrend line here. If price sells off and gets really below this, that would not be a good sign. That would be more indicative that we're just going to go back to the lows. Next. Chart number 15, here's a 60-minute view, the chart we've been showing for the last week or so. And this is the more bearish view, that we had a rising wedge here. And this would allow perhaps to go back to new lows. Okay. If we get a little rally earlier this week before midterms, this 3,800 area would be your first major resistance area to watch. Again, these fibs are important, especially the 61.8 fib at 36.50 if we were to break that. Next, chart number 16, there's a 5-minute view, just showing the action the last couple days. Very whippy action the last couple days. On Friday, we had a really nice trade setup here. Congrats if you caught this short from the morning, but you had a nice long opportunity late in the day out of this coil. Produced a nice rally out of that coil the last couple hours of the day. Next, moving on to the KISS trend systems. Remember, we're in a bear market, so these are mostly going to be in cash. These systems are designed to be long only and keep you in the S&P 500 and the triple Qs with a DVT that's like a dynamically raised trailing stop. Tries to make them wide enough to not, get triggered on noise, but also give you protection so that you avoid, 20-30% down, corrections that will occur in bull markets. Okay, and also keep you out of bear markets. So the weekly version of the KISS, it got out in January right here when the DVT at 43.70 was hit. It actually then took a long opportunity there in July, making a little bit of money on that. Let me zoom out into that. It actually price stalled right here at the ATR, which not surprising, was a perfect resistance area. Also matched here with the 50-week moving average, weekly moving average. Everything lined up there, and then the system raised the stop all the way to 40.58. Got out there in September. Was a good time to get out. But anyway, it's in cash. It's most likely going to be here in cash for quite a long time. Next. Chart number 18, here's the daily version of the KISS system. It's because it's a daily, it does have a little bit more noise, a little bit more dynamic. It also got out in early January. It then went long here in March, got out in early April after the DVT at 44.14 was hit. It then went back long in July right here. It was able to set 5 new trailing higher stops, got out at 40.88 here in August, and it actually did go back long just over a week ago. At the time it did go back long, I said I don't like that buy. If you want to follow this, best to buy a pullback. DVT was pretty wide there at 36.36. So if you did buy this, it would follow this. It would have been better to buy it, late last week on that pullback. By the way, that 36.36 DVT is pretty close to that 36.50 area where the 61.8 fib lies that I said is very important. So that fib does make sense from an importance standpoint. Next, chart number 19. Here's the various time frames where we have the cycles we like to look at. On the daily, we had a bearish resistance cycle early last week to mark 9 and price pulled back. Again, we have the ATR as potential support. We do have a buy cycle on the half day here and some on the 130 minute, but we'll just see how things go. Tonight, as I look at futures, ES futures are down about 27 points. We'll see how they fare in the morning. Next, chart number 20, here's the triple Qs. This is a monthly chart. Again, guys, this was the previous bull market. It ended with a blow off. I mean, look at that slope change you had there, and money printing bubble, and pretty good correction here so far from the March 2020 lows. We've gotten near the 61.8 fib. In fact, the lows, that's where they tagged. So far this month, down 4.8%. Next, chart number 21, here's the weekly view. Again, in this expanding triangle to the downside, as you can see. Closed back below its 200-week moving average here, unlike the S&P, which is still above it. Next, chart number 22, here's the daily view of the Qs. Again, they're the weakest. Just look at the big tech stocks. They're getting killed lately, even Apple. And not too far away from its October lows. That last rally stalled right at the 38% fib from the August highs to the recent lows. So that's exactly where it stalled. And we'll see what happens here, guys. Stochastics is oversold. MACD is kind of pinching here, but price really needs to bounce here if it's going to do so. Otherwise, this could easily just flush to the downside. Your moving average ribbons last week was also pinching on the underside. Next, chart number 23. Here's a 2-hour view. Again, you can see how price stalled at that 38% fib previous week. Next, chart number 24. Here's a 60-minute view we were shown last week. Once we broke that uptrend channel, then we had that good sell-off the rest of the week, except the bounce on Friday. Next, chart number 25. Here's the triple Q's KISS daily system. Again, very similar to the S&P. It went long there in March, got out in early April. It went long in July, got out in August. It made money here. And unlike the S&P, this did not go back long. Price stalled right at the ATR here and was rejected there. So this has been in cash. Next, chart number 26. Here's the various cycle time frames. Very similar look to the S&P. I'm not going to go over these in depth. So let's go ahead and move on now to some market sectors. Obviously, the bright spot this year has been energy. If you go back and listen to our newsletters late last year in December and in January, we talked about energy was the place to be, the area you could buy a basket of energy stocks and hold them for swing trades, and that has been the case. Yes, a lot of energy stocks did top out in June and then had 3-4 month consolidations, but as long as you stuck with it, they're back to the highs. Here's the XLE daily. Again, there's a little divergence here now short term, but These have been the epitome of strength this year. Next, chart 28, oil services, same deal. This is almost back to those recent highs. Next, chart 29, ExxonMobil. Again, guys, the thing to do was to buy the energy stocks back last January when we talked about it. If ExxonMobil, you bought it here and just held it, you're a very happy person. You also got several dividends between then and now as well to add to your profits. Next, chart 30, XLC, communication sector. This really shows you a lot of these former FANG name stocks, how they've been hit. Take a look at this. It is almost retraced. It has retraced most of that 2020 move now. That's your next potential support here. Next, chart 31, XLK, technology. Similar to the Nasdaq, down 6.6% for the week. I'm just showing the weekly chart. This is your demand zone right here. Next, chart 32, XLF financials. Now they've done better. This recently got near its 200-day moving average, stalled from there, but so far price is still, technically it still looks okay here. Next, chart 33, IYR real estate. Bounced off the 61.8 fib about a month ago, not surprising. Moving average ribbon got super wide there and has bounced back a little bit. But guys, longer term energy real estate is toast. Typical 30-year mortgage is something like 7.3% now. I read an article that they're expecting it to hit 10%. I also read that in Las Vegas, which folks look at for real estate because things typically happen there first, that something like 30 real estate agents a day are quitting the business. That's a day. That's not a month every week. That's every day. Tells you how hard it is in that market. Not surprising. And obviously refinances are basically zero now unless you absolutely have to. Next, another sector I haven't commented for a while, and this is a chart that was posted by one of our subscribers, AmCamp, and I thought it was a very nice chart. This is emerging markets. They've gotten pummeled this year, but it has come back to this uptrend line here, which has been, every time prices come back to this area, it has rallied, and you can see that's what it's doing for now. This is obviously going to depend also on what the US dollar does. If the US dollar were to strengthen again and make a new high, then this would likely sell off again. But if the dollar does weaken, this may finally have some sort of decent rally here. I'm not expecting it to go back to new highs, guys, maybe some sort of lower high, but could be a trade opportunity here. Again, got to keep an eye on the US dollar. Next, chart 35, here's a longer term view daily of EEM. So these represent your symmetry. And we did get a pretty nice pop on Friday. We did break some short-term symmetry via these cyan lines. Obviously, we're a long way away from breaking these longer-term symmetries. Next, chart 36. Here's the shorter-term daily chart. Again, we had some divergence here on the RSI, MACD. We gapped on Friday on some volume. If the dollar continues to sell off, this will likely rally. This would be your first major resistance up here around 38. All right, let's look at some market indicators. Chart 37, here's the VIX. So all year long, this upper mid 30 area has been capping the rallies of the VIX. Eventually in this bear market, I do expect the VIX to take this out in a big washout, but so far it hasn't happened in this bear market. And the VIX closed inside its Bollinger Bands early last week and has continued lower. But one thing to watch here is the VIX is now uncorrelated with the market. And usually when you get these uncorrelations, those usually occur near some inflections in the market. So that has my attention. Next, chart 38. Here's the VIX with the DeMark. And we had a DeMark 13 last week, and the VIX has so far come down a little bit lower. Now, this is definitely something to also watch because typically the VIX responds to these DeMark cycles. You can look at all these cycles of the past to Mark 13s, to Mark 9s, Mark 13 to Mark 9. The VIX usually doesn't trend for long periods of time like the S&P, so it tends to react better to DeMark than the S&P. So anyway, the fact that we had a DeMark 13 here and it hasn't reversed yet does pique my interest. It tells me to be careful on the long side because this could be in an area to soon bounce. Next. Chart number 39, here's another chart of the VIX. Also has this correlation indicator, a little more focus on it. Here I added the areas where the VIX became uncorrelated with the S&P. So the VIX, S&P is up here, the VIX is down here, and you can see how uncorrelated it is right here. Again, sometimes the uncorrelations occur near a major peak in the S&P. Sometimes they occur near a trade low. Okay. Next. Chart number 40, here's another chart of the S&P. So should the market instead form a higher low and rally, the VIX also may want to work down to this demand zone down here. You can see this potential large coil that could be forming, and a rally would allow the VIX to come down into this zone. That would allow for further rally in the market, you know, that wave C scenario I talked about. Next. Chart number 41, here's a weekly chart of the VIX. Again, guys, sometime in the bear market, I do eventually expect this, I do expect the VIX to rally out of this large basing pattern. Okay, hasn't happened this year, but sometime during the bear market, I do expect that, especially if the market were to sell off to new lows now. Next. Chart number 42, here's a breadth chart. It's represents the Nasdaq 52-week highs, 52-week lows, and the difference here at the top. And this has been an astounding chart. I talked about this chart last December, and I talked about it all year. I said whenever the difference between the highs and lows approaches the zero, I said that would give you objective short opportunities. You can see that every time this is approached zero, has called all these major highs this year. Okay, even recently, the last couple weeks, it got near zero here. When it gets way oversold, gets below the lower Bollinger Bands, those are when you tend to get trade lows. All right, this has been a very effective indicator in this bear market. Next. Chart number 43, here's a 60-minute chart. This compares the S&P at the top and the HYG high yield corporate below. And typically what you look for here is divergences. Let me zoom in on here a little bit. So again, you can see whenever the high yield corporate here had a lower high in August, S&P had a higher high, that ended up calling this high. This has been very effective at calling recent highs and low inflection points. Recently, you had another divergence here in late October when the S&P made a slight higher high here, but the high yield corporate was declining. Next. Chart number 44, here's another chart that works very well. This is the S&P versus the S&P XLP ratio here at the bottom. And also in late October, this was diverging. The S&P formed a higher high here relative to this peak. This formed a lower high, and that was a little bearish short term. Next. Chart number 45. This shows you the percentage of stocks in the S&P 500 that are above their 20-day moving average. And this has been a very effective indicator too. All year long, every time this gets up around this high 80% area, that's called the peaks of the market all year, and that we had that here recently. And every time it's gotten to this low area, 10% or so, has been trade lows. Next. Moving on to bonds and interest rates. So chart number 46, HYG, high yield corporate. This tends to move with the general market. So far last week, it found support at the 61 fib. That's the important area, guys. If it holds that, that would be positive short term for the market. see. Again, this is going to be important here because if this were to rally up here, that would allow for the S&P to have that ABC, that C higher low wave B, big move up in wave C. If instead this declines, then that would take the market down with it. Next, chart 47, TLT 20-year bonds. Again, so far they haven't yet revisited their October lows, but last week they did stall here. We'll see what they do early this week. Next, chart 48, here's the monthly view of TLT. Been one hell of a bear market for bonds. Started in 2020 really, but really accelerated this year. This is your big demand zone down to this area. Whether we get down to there or not, short term here, we'll see. If the S&P does have that move down to the lower 3,000s this fall, then I would expect that to happen. Next, chart 49, here's the 10-year treasury yield. So far just chopping around here. We did have a little divergence up here, but we haven't broken symmetry yet. Once we break symmetry, that'll confirm a lower high in place. Next, chart 50, here's the yield curve. As you know, this has been buried for much of the year. So one of the best predictors of a future recession, which again, guys, is basic, in my opinion, is inevitable. Next, let's move on to the currencies. Chart 51, US dollar. I'm showing the weekly chart. So the dollar for the week was up 0.15%. The previous week, it did break symmetry. Okay, had a pullback of 540, larger than that previous pullback here. So I commented a week ago that did give higher odds for the dollar to form a lower high. Okay, again, obviously the dollar's had one hell of a rally from this double bottom in 2021. We had some RSI divergence up here. Again, we did have a symmetry break the previous week, so that's something to be aware of. Next, chart 52, US dollar daily chart. In early October, I postulated that first rally was a wave B. A lot of people thought I was crazy. Thought the dollar was just going to go right back to highs. I ended up being correct. It came down as a potential wave C. Big reversal on Friday. Now we'll see if this ends up going back to these major support areas here, or is a more complex bullish correction with another breakout to the upside. Next, chart 53. Here's a zoomed out view. Again, this uptrend line from February 2022, that's your major support. This is your resistance. So we'll see which way this resolves. So this is going to be important for what gold, precious metals do, and the general market and commodities. Next, chart 54, FXE, that's the euro. The euro has been absolutely pulverized the last couple of years, this head and shoulder top. And you can see here, this is your larger symmetry. Now, euro has had a pretty good rally off the September lows. It hasn't broken the larger symmetry bounce, which was from this measurement. But if you start measuring the rallies from here, that's why I marked these as a different color. You did have a symmetry break here, so it does give you some odds at a higher low. You also had a bullish MACD cross. That gives us some odds maybe that the dollar does have more consolidation to do. Next, chart 55, Japanese yen. What can I say? They've absolutely destroyed their currencies, completely filled that thin zone from all the way back in 1998. Next, chart 56, Japanese yen weekly view. You do have some MACD divergence here. You had a doji hammer light candlestick a couple weeks back. Next, chart 57, here's the daily chart. Little tight pattern coil here setting up. Moving on, chart 58, Bitcoin. So Bitcoin so far this year has been holding this major support. We had a little breakout in October, that occurred along with the general market rallying. Little pullback late this week, but it still looks okay. Next, chart 59, Ethereum. Nice rally from this tight coil. Stalled at this downtrend line resistance area, but it still looks okay. If this were to break out, cryptos will break out That would also be a positive for the market. Next, let's move on to commodities. Chart number 60, DBC, commodity ETF, up 5%. Clearly breaking this downtrend line here of this little pattern. Again, commodities have had one heck of a bull market run since the 2020 lows. Yes, they had a pretty good consolidation here from the July highs, but last week they're breaking over this trend line. Next, chart 61, DBC monthly view. Okay, you could see that pullback into July basically found perfect support here, which was previous resistance became support. So far this month up about 5.8%. Again, long term, guys, this is in a long-term uptrend. You can see where the moving average ribbon flipped bullish back in early 2021. Talked about that in my newsletters way back then. Next, chart 62, here's the CRB to the S&P 500 ratio. So for many, many years, commodities have underperformed the S&P, so the ratio is declining. You can see the moving average ribbon, same thing. But I talked about this a year or two ago where we started seeing a basing pattern forming in this ratio. Multi-year base forming. And of course, that ended up starting to play out this year where this ratio went to the upside as commodities outperformed the S&P. You could see how the moving average also turned bullishly stacked here in early 2022. And again, despite some consolidation here in the summer, into the early fall, moving average is still bullishly stacked. It still looks like it's in a long-term uptrend. Next, chart 63, crude oil had a big rally on Friday, up 5%. We had it identified as a bullish falling wedge back in September, broke out of there. It broke symmetry. Whenever you break symmetry, you look for a higher low, which we got here. Many of you guys went long with me at that time. It's been a nice move. Next, chart 64, there's one of the tradable ETFs, USO. Probably how most of you took along via this ETF instead of the futures. Perfect support almost at that 61 fib. Nice rally on Friday. Next, chart 65, natural gas up 12.6% for the week. It's been very whippy this year. Obviously, it's been a nice uptrend from that 2020 lows where it hit about $1.50. That was the ultimate bottom. But big parabolic moves, consolidations, parabolic moves, consolidations, etc. Found some support near this weekly uptrend line about 3 weeks ago. Next, chart 66, here's the daily view, now breaking over this channel line. Next, chart 67, here's Boyle. This is the 2-time leveraged ETF. I trade this over at UNG. UNG, you get those annoying tax K1s. Nice little volume break trend line here on Friday. Next, chart 68. Moving on to copper. Big breakout on copper. We've been showing copper lately as this tight coil. Really nice breakout on that coil. Next, chart 69, CPER. That's a way to play copper itself. It's the ETF. Next, chart 70, SCCO, Southern Copper. Probably the better way, though, to play copper would be with one of the stocks, guys, instead of the ETF. This has a really nice basing pattern. Broke out on really good volume here, as you can see. So if copper's going to go up, this will go up. Next, chart 71, DBA, agriculture. Big run that topped out earlier this year. Sell off. We had a bear wedge here that played out. Little bounce last week up 2.4%. A lot of us are concerned, though, about what these agriculture commodities and prices are going to be next year. I'm hearing Armageddon with potential food prices, with all these droughts and everything else. So hopefully it doesn't happen in 2023, but who knows? The way things are going, it would not surprise me. Next, chart 72, here's DBA on the monthly view. Again, it started its bull run back here in 2020. You can see where your moving average ribbon on this long-term chart flipped to a bullish stacking. And, while they did have a good consolidation this year, Doesn't it look like simply a bullish consolidation in a long-term uptrend? Look at those volume patterns. Look at the moving average ribbon pinching. That's all it looks like to me. Looks like a good first pullback in a long-term bull market uptrend. Next. Chart 73, URA. Someone asked me to look at uranium. I haven't looked at that in a while. It started a bull market back here in late 2020. Very volatile, as you know. To me, this is something, it looks like it could be forming some sort of bullish wedge over time. It may need to work its way lower here for a while. Remember, this is a weekly chart. Next. Chart 74, sugar. Have been showing this for a while. It's consolidating into a tight pattern here. Maybe breaks out. Cane is one of the ETFs. Let's move on to precious metals. Chart 75, gold. This is the monthly chart. So far it's up 2.2% for the month. A little bounce. Again, it had a double top early this year. We identified this bullish rounded base pattern back in 2019. That played out. But this year has not been a fun year for the gold bugs, especially if you didn't take profits back early part of the year. Short term, though, they interest me now for a long, so let's take a look at those. Chart 76, here's a daily chart. So we did have a big rally on Friday, but again, your major resistance is this 50-day moving average, which capped the rally last time in early October, and the downtrend channel line. Price needs to strongly break out of this and hold it. Okay? Going to depend on what the dollar does. So far, that 1620 area has been defended as support. Next. Chart 77, here's another daily view. This one has the GDX-GLD ratio. You want to see the stocks outperform. Remember, the stocks typically lead. Next. Chart 78, silver, up 8.5% for the week. This was your demand zone we had drawn away earlier this year, which price did defend. Nice rally here, but it needs to clear some resistance. Next, moving on to the stocks, chart 79, GDX. So GDX had a big day on Friday, up 10%. Okay, we identified as a potential fifth wave low back in September. They topped out there in April, and since then it's been this very choppy sideways pattern. These sideways patterns can frustrate the hell out of you. Anyway, this would be potential bullish views. So one view would have that as a wave A. This is an ABC consolidation. We'll either go up in wave C or 3. Okay, but we need to go up and break the downtrend line here. Price needs to hold this low. If price were to suddenly reverse back to the downside, if Lucy grabs the football here, which it has done all year, there's been so many failed attempts. If it just suddenly reverses here, then it's likely just going to go back to new lows. So they need to have follow through, and the dollar is going to be key. Next, chart 80, here's GDXJ. Again, very similar patterns. Again, a lot of these look really bullish as long as we can get some extra follow through on Friday's gains. Next, chart 81. This chart has these various GDX-GLD ratios with moving average ribbons. And one thing I point out here is on the GDX-GLD ratio with the moving average ribbon, you can see it turned bearishly, stacked here in April. And finally now it's pinching. When it's pinching is when you have energy built up, and that's when you get your bigger moves. Okay, so everything's lined up here for a potential bottom and breakout, but we need to see it go. Next, chart 82, SILJ. This also looks potentially bullish. This is the silver stock, silver junior ETF. Here I added a potential symmetry move. I did carry some of these home along from Friday, so let's hope I don't get nailed on Monday, guys. Next, looking at a few individual names, chart 83, CDE. This has really been one of the stars. It had a double bottom here in September, and it started outperforming here. You can see on the ratio here. It's been outperforming the others, and it's been technically uptrending. You have higher highs here, higher lows. trying to break out of another bull flag here at the moment. Next, chart 84 FSM. Here's a silver stock, kind of a bullish look to it here. If we can take out this trend line, nice volume patterns here lately. Next, chart 85 AU. Anglo gold. I like how the ratio looks, the AU to gold ratio, breaking out of the trend line. Super volume on Friday. Next, chart 86 BVN, another gold play, breaking its trend line on Friday. Ratio has been uptrending actually since September, so this has been outperforming. Next, chart 87 NG, yet another gold. So here's a handful of them for you guys to monitor if you play this area. Let's see what happens earlier this week. And let's follow up on some other trade ideas that we've had. Chart 88 EXTR was a long idea I had back here in October. Potential cup and handle. And so far this has played out beautifully. This was your resistance here. Broke out, pulled back to the 9 EMA, found support there. One heck of a trade. I know a few of you caught that one. Next. Chart 89, 9. So one of our astute members pointed this out to me about 3 weeks ago. It's an energy play coming out of a long-term base. If you ever read Stan Weinstein's book, he talks about these basing patterns, stage 1. So it was coming out of here, started to. It looked bullish, and boy, I wish I had bought a big position in it because it just keeps going up week after week. Up 33% last week alone. Next. Chart 690, here's the daily. Again, just up and away. Every pullback so far, since we've been showing it, like it started showing it there in mid-October, every pullback has found support at the 9 EMA here. Every single pullback will not come in. Next. Chart 91, Z-Scaler, one of our recent short ideas, breaking down from this bear flag. Beautiful short. Next. Chart 92, Adobe. Recent short idea of ours, also broken down last week. Nice trade. Next. Chart 93, MNDY, another short of ours from last week. Beautiful trade. Next. Chart 94, CROX. This was a recent short of ours. It gave us a little trade, but then last week it had earnings on Thursday, and look at this volume reversal. In fact, this looks like one of those Stan Weinstein plays. This looks pretty damn bullish here, especially if this follows through. Next. Chart 95, Daku, another short idea of ours last week. All right, guys, so we'll see what happens this week. So when I started recording the newsletter here, futures were down about almost 30 points. They are now down 19. So again, we'll see. They have come off the lows. We'll see how they open on Monday morning. Have a good rest of your Sunday evening. Take care.